What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell for me so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. I do not have an investment trading program. So please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Weeble is going to give you up to 12 free stocks. When you open a new Weeble brokerage account, put at least one pin in that account, they're going to give you up to 12 free stocks. There's a link down in the description box of the video. Click on that Weeble link. Open up your new brokerage account today. Go get that free stock. Go get that free money. The Federal Reserve has made it plain and clear. They're not going to stop increasing short-term interest rates until they see a sign that inflation is starting to come down. Yesterday, the Federal Reserve increased short-term interest rates by 75 basis points. But the market actually rallied for a short period of time after that increase. And the reason it rallied is because the market had already priced in that 75 basis point rate hike. What the market did not price in was the comments the Federal Reserve Chairman Jerome Powell said after the rate hike, where he basically made it clear that the Fed is going to continue to be hawkish when it comes to getting inflation down. All that means, guys, is that they're going to continue to increase short-term interest rates until that happens. The market did not like those comments, and the stock market actually sold off pretty heavily after the chairman made his comments yesterday. Where are we at today with the market? It's continuing to sell off, guys. And the reason it's continuing to sell off is because investors are not clear of when inflation is going to come down and when the economy will get itself to a point where companies can start growing again. Last week, we had some of your biggest tech companies post lackluster third quarter earnings reports. And that's one of the reasons why these companies are reporting these bad earnings reports, is because products, services are not selling up to expectations. And when they don't sell up to expectations, these companies have to come in and report that. Why? Because they're publicly traded companies. They're required to report what's going on with the financial condition of their companies. Now, big tech companies like Amazon, Apple, Meta are not in trouble, guys. These companies will be here tomorrow. But what we are seeing with all three of these big tech companies is when it comes to their products and services, sales are slowing down. You know, advertising revenue for Facebook/Meta is slowing down due to competition from TikTok, right? Companies like Amazon, sales are slowing down. Why? Because people are not buying as much stuff on Amazon over the last quarter. And then when we look at Apple, they rolled out the iPhone 14. The lower model versions of that iPhone 14 are not selling very well. So that's all contributed to the economy. It's all contributed to high inflation. Unless we can get price stability back into our economy, we're going to continue to increase these short-term interest rates so we can make it harder for people to go out and borrow money cheaply to buy things they really don't need. And that is the direction the Fed is going to continue to go. So in December of this year, we can expect another 75 basis point rate hike. The only way that doesn't happen, if we get data before that December meeting, that gives the Fed an understanding that inflation is starting to come down, then we may not get the 75 basis point bump. Maybe we get a quarter of a bump, right? Maybe we get 50 basis points. We don't know yet. We'll have to wait on the October CPI numbers so we can see where inflation is. We already know the September jobs report came out, and it's still a pretty strong labor market. Look at the report yourself, guys. Go out online and pull it up, right? If you look at the labor reports, you'll see where there are more job openings than there are people to fill those jobs. All right. So that drives up wages. Wages were up month over month, 7.7%. So strong labor market. People have strong savings, right? There's a lot of savings that people have accumulated over the last couple of years from all the different things like the stimulus checks and people just cutting back during the pandemic, and they just started putting that money in their savings account. So now people got all of this money, plus they getting wage increases. They continue to spend. People continue to take lavish vacations. People continue to buy things they really don't need. And that's hurting our economy because that's continuing to drive up inflation. Why? Because we still have a supply chain issue. We still haven't gotten the constant between supply and demand is still not quite there, right? We still have an over demand for a lot of our consumer products and services. We have an over demand still and an under supply. So that's going to continue to run prices up if people continue to just buy things that they really don't need. Now, everybody got to buy their basics. We know that. You got to buy your basics, but outside of your basics, some of these things we're buying we really don't need, and really that's hurting the economy as a whole, right? And that's what the Federal Reserve is saying. Until people understand that they got to stop spending money on things they don't need until we can get supply and demand on the same playing field, that's going to continue to run up prices. Think about it. Now again, the grocery store is just one example. We know the grocery store, everything in there is 25% higher than it was last year. We know when you go to the gas pump, the gas is higher than it was last year, right? We know that. But again, some of this discretionary stuff that we don't need to spend money on, that's where we're really hurting the economy, in my opinion. And I believe that's what the Fed is saying. But the Fed is saying, look, if we don't stop people from spending money that they shouldn't be spending on things they don't really need, then we're going to keep raising these interest rates until they start feeling some financial pain. Once they feel that financial pain, I guarantee you they'll stop. And that financial pain is when people start losing their jobs. Because I'm going to tell you what's going to happen is they keep raising these rates, guys. All of these companies, these small companies, medium-sized companies, large companies will not be able to borrow money to expand and grow. And if they're not expanding and growing and increasing revenue, guess what? They start laying people off because personnel is their biggest expense. And the Fed knows that. That's why they keep jacking these rates up. Because they know at some point there's going to be a breaking point for companies. And companies are going to start laying people off. When people start getting laid off, they'll get the picture. And I hope it doesn't come to that. But I'm telling you, based on what I heard yesterday from the Federal Reserve Chairman Jerome Powell, the Fed going to keep raising rates, man. Even in 2023, they're just going to keep raising them until people get the message. Stop spending on things you really don't need. So guys, drop me some comments. Let me know what you think about the Federal Reserve's stance on inflation, their hawkish position, and how it's affecting our stock market. Now, short term, right? It's affecting the stock market short term. Obviously, long term, the stock market will be fine. Again, just like I say in every video, guys, perfect opportunity for us as investors, retail investors, right? Individual investors. Perfect time for us to be gobbling up our favorite companies, favorite ETFs, favorite cryptos while they're on sale. Hold them long term, man. 3, 5, 7, 10 years, we're gonna make out really nicely, in my opinion, right? So drop me some comments and let me know what you think about that. if you want those 12 free stocks from Weeble, click on that link, man. Go get those free stocks. Go get that free money. Plus, it's a great self-directed brokerage app for you to be able to buy your favorite individual stocks, buy your favorite ETFs, and some of your favorite cryptos. No commissions, no monthly maintenance fees, no annual maintenance fees. Just a great platform to be able to buy these paper assets. I use them every day. So, hey, if you want something convenient and easy to use, go down to the description box and click on that link for Weeble. Get them 12 free stocks. Go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.